Hello, everyone. Welcome to this edition of Kuvera Insights. My name is Neelabh, and as always, we talk to industry participants and bring their words of wisdom for you. Today, we will attempt to shed light on a specific category of mutual funds known as focused mutual funds. Joining us for this discussion is Mayur Patel from IIFL Mutual Fund. By way of a quick background, Mayur is the Senior Executive Vice President of Listed Equity at IIFL Asset Management. Mayur has 18 years of experience with 14 years in the investment research and investment management space. In the past, he has worked with DSP Investment Managers, Spark Capital, Tata Motors, and CRISIL. Mayur is a CFA charter holder and a chartered accountant by training. A warm welcome, Mayur, and it's great to have you with us today.
Thank you. It's a pleasure.
So getting started right away, our first question to you, could you help us understand the focused equity mutual fund category and probably bring out a few key positives of this category?
Thanks, Neelabh. Thanks for the opportunity once again. Focus fund is a type of equity mutual fund that invests in a limited number of stocks, a maximum of 30. So these funds are sector and market capitalization agnostic. That means a focus fund can invest into large cap, mid cap, and small cap stocks without any restrictions. So while a focus equity fund may have slightly higher risk because of higher concentration, it does have some positives, such as one can adopt a bottom-up strategy and with higher emphasis on security selection and increased research depth per company. Secondly, larger weights could be assigned behind highest conviction ideas. Thirdly, one can select the best of the prime ideas in selected industries. And last but not the least, one can try to achieve a more optimal risk-reward mix of market capitalization. Means wherever across large cap, mid cap, and small cap, wherever the risk rewards are more attractive, one can have a larger allocation to that part of market capitalization. So these are some of the positives of focus equity mutual fund category.
Right. So that's useful to understand. Now, given the concentration, would it be fair to say that focused funds could have higher volatility and higher risk? And with that context, how does IIFL mutual funds framework help to deal with this or help to address this?
Sure. So if you see, there are the time period of 5 to 7 years before COVID was witnessed a cycle of sharp outperformance, very strong outperformance by quality growth companies. While last few years, we have seen a strong rebound in the value segment. So different segments of the market perform in cycles. So while focus equity as a category, would have a concentration, and that would imply slightly more risk. There could be different ways of managing that risk. So as of at our end, we have adopted, in order to reduce the volatility in returns over various cycles, we have adopted a SCDV framework of stock selection. So this framework enables us to invest across secular, cyclical, defensives, and value traps quadrants of the market that can help us, reduce the volatility of returns over various cycles.
Right. So you use the abbreviation SCDV. Could you help us understand a little more about that? And this is something which is proprietary to IIFL Mutual Fund?
Yeah. So as I mentioned, to reduce the volatility in returns over long term, we have adopted this framework. And, essentially what it does is when quality and growth factors are in favor, the secular and defensive segments of our portfolios, will do the job, while in a cyclical upturn, our cyclical bets would help. So let me just elaborate a bit. As a fund house, we split the market into 4 quadrants: secular, cyclical, defensives, and value traps. So secular forms a core part of the portfolios. It comprises of companies which are consistently delivering more than 15% profit growth and more than 15% ROE over long term. These are quality growth companies with having secular growth drivers in place. Examples would be private sector retail banks, retail focused NBFCs, consumer discretionary, insurance, retail, and auto. The opposite of that is the value trap segment, which comprises of companies which have struggled to deliver 15% return on equity and 15% profit growth over long term. So examples would be public sector banks, telecom, oil and gas, and utilities. So we always try to have an underweight in this quadrant.
Right.
Then we have cyclicals and defensives. So cyclicals as a quadrant would have sectors which move with economic cycle. Examples would be industrials, corporate lending banks, metals, cement are some of the sectors. The ROEs in these sectors tend to be low or long term, but they do see a sharp growth in profits in cycles. Defensives, on the other hand, would comprise of high quality companies with very high return on equities, but modest growth over long term. Examples would be FMCG, healthcare, and IT services. So, we try to allocate weights between cyclicals and defensives based on our views on the macro environment and the economy. So, essentially, there are three buckets. Core is your secular segment, tactical bucket, which has cyclicals and defensives. The allocation moves based on our views on the macro environment and the economy. And last but not the least, value traps, which is the least preferred segment. We would always be very selective in selecting stocks from this segment. So That's our SCDV framework, which forms the basis of stock selection.
No, fantastic, and that's very interesting to understand the framework, which actually also brings me to my next question. So there has been a lot of changes in the inflation numbers, probably precipitated by rate hikes or the reverse, not only in India but globally, and these have become sort of key areas of discussion, and in many markets these are also a cause of concern. What is your view, and how do you see these factors affecting our markets and probably even the global markets?
So inflation seems to have peaked out across the globe. Therefore, the pace of interest rate hikes would soften too. So we have seen US Fed increasing rates by around 425 bips since the beginning of the last year, while RBI in India has increased by 225 bips. So going ahead, maybe 50 to 75 bips from here, and then interest rate cycle would peak out. And actually, it can decline in the second half of this year. So more than the interest rate and inflation, the concerns are around length and depth of recession. That's what is going to matter the most for broader markets. Good thing is, in India, the demand is relatively robust despite all the interest rate hikes and the inflationary concerns.
Understood. So at this point, we are, sort of heading towards, without saying so, but we are probably closing in towards the bottom of the market in some ways, maybe a couple of months here and there, from a valuation standpoint. Which are the sectors in this context, in the current framework, which are the sectors that you guys are optimistic about?
So sectors that are inward facing or dependent on domestic economy are better placed than sectors that are outward facing, which are dependent on global factors. So we are positive on the investment cycle in the country. And therefore, we think that domestic cyclicals like financials, industrials, and automobile are better placed in this current environment. So after a decade of muted growth in CapEx, finally, we are seeing some pickup in the cycle. So marked improvement in corporate balance sheets are supported by increased appetite for lending by banks is what is causing the rebound in demand for capital goods. Also, government policies such as PLI scheme are undoubtedly focused towards encouraging Make in India. On the export side, if we see, incrementally more and more global players are becoming more positive towards Indian manufacturing companies because of the China plus one strategy, which they have adopted. So India is set to become a hub of manufactured goods exports, and if we net join all the dots together with a benign outlook for exports and cyclical recovery in the domestic demand, we think the domestic cyclicals are set to deliver good growth in the medium term.
Right. Oh, fantastic. That's very helpful. Hopefully, we are from a markets perspective. Hopefully, we will fare better. We have come a long way from where we were and how dependent we were on the external sector and FIIs from a market volatility standpoint. But I'm sure there is a lot to look forward to, and from this conversation with you today, we feel more confident about the same. I'm sure our viewers will find this discussion very useful, and they will take away a better understanding of focused mutual funds and this category of mutual funds. Thank you very much, Mayur, for joining us today. Have a good day.
Thanks for the opportunity, Neelabh. Thanks a lot.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.